Now, let's begin with the introduction of SME. Small and medium enterprise or SME play a vital role in economies around the world. They contribute significantly to economic growth, drive innovation, and create employment opportunities, which making them the backbone of dynamic and competitive economies. However, despite their importance, SMEs often operate in highly challenging and competitive environments. They commonly face financial constraints, limited access to resources, and rapidly changing market conditions. This challenge places significant financial pressure on business owners and increases the risk of instability or failure. Therefore, effective and customized financial management practices are crucial for SMEs. Proper financial planning and control help business manage their resources efficiently. And also, it can maintain financial stability, overcome operational challenges, and ultimately achieve long-term sustainability and growth.
Now, I will explain in detail about the background of small medium-sized enterprise. Small and medium-sized enterprises are crucial to economic stability and growth in both developed and emerging economies. One of the main issues SME face is obtaining outside capital, and many SMEs still struggle to get the funds needed for their growth and development projects, even the efforts of government and institutions to provide support and access to financing. This has made it more difficult for them to expand their business, seize business opportunities, and promote sustainable economic development. SME are also looking into alternative funding solutions like borrowing from friends and family. The government, commercial banks, and central bank are advised to work together to address these problems. Commercial banks would provide working capital and leasing financing for machines and equipment, while the government would supply the required economic infrastructure. This collaborative approach will ensure that SME have the financial resources they need to prosper and contribute to economic growth. Let's move to the objective of SME. One of the objectives is cost control measures, which examines methods for reducing operating expense without sacrificing quality, and investigate ways to maximize the use of resources in order to reduce costs. The second one is cash flow optimization, which determines how to keep SME cash flow healthy and analyze the effects of effective payment collection and invoicing procedures. Next, competitive positioning. Examine how SME competitive advantage is influenced by efficient financial management, and a complete performance review involves benchmarking against industry norms. And the last one is working capital efficiency, which look for ways to make working capital management more efficient and assess the balance between short-term assets and liabilities for optimal performance.
For key financial management strategies for small business, there are several key strategies that small business can apply to ensure business survival and long-term growth. First, variety of financing sources is very important. Small business should not rely on only one source of funding. Instead, they can explore different options such as bank loans, government support programs, alternative lenders, or even crowdfunding platforms. By having multiple sources of financing, business can reduce financial risk and increase their chances of securing funds when needed. Next, effective cash flow management plays a crucial role in daily operations. Business owners of small business need to regularly monitor their cash inflows and outflows to make sure there is enough money to cover expenses. This can be done by planning cash flow forecasts, managing payments from customers efficiently, and keeping a cash reserve. Therefore, enough liquidity helps business stay prepared for unexpected expenses and financial emergencies. Another important strategy is cost control and expense management. Small business should carefully track their spending and avoid unnecessary expenses. This includes negotiating better deals with suppliers, reducing waste, and reviewing costs regularly. Thus, managing expenses properly helps business maintain profitability and operate more sustainably. Besides that, small and medium-sized enterprises should consider investing in technology and automation to help streamline their daily operations. By using technology, business can work more efficiently and reduce unnecessary costs. This may include implementing accounting software, inventory management systems, or e-commerce platforms. Thus, these tools can help improve financial process and at the same time increase overall productivity. Last but not least, for risk management and insurance coverage, small and medium-sized enterprises should assess and identify potential risks that may affect their business. After identifying these risks, they should implement appropriate risk management strategies to minimize possible losses.
The mixed methods technique used in the study integrates both qualitative and quantitative research. The quantitative data is collected through surveys or questionnaires to understand current financial practice and challenges faced by SMEs. Furthermore, in-depth interviews with SME owners and managers are used to collect qualitative data and investigate their financial management experience and perspective. A SWOT analysis, strengths, weaknesses, opportunities, and threats is used to analyze financial management methods in SMEs. Lastly, sampling technique is used in the study to choose SME managers and owners with relevant financial management expertise. This approach helps provide a comprehensive understanding of financial management issues and identifies areas for improvement.
Now, I will explain about budgeting and forecasting for SME. Budgeting and forecasting are institutional financial management strategies for the expansion of SME. These strategies involve setting financial goals and making plans to allocate resources effectively. SME can set goals for profitability, cost control, and revenue generation by making a budget. SME can use forecasting to predict future financial patterns and make well-informed decisions based on projected outcomes. The first one is budgeting for SME development. Recognize your present financial situation, which examine your current financial statements to gain insight into your cash flow, expenses, and income. And identify areas where you can save costs or optimize your spending. The second one is forecasting sales, which create accurate sales forecasts by considering market trends, past data, and any impending changes, and consider the market, seasonality, and any effects on sales. And the last one is management of cash flow, which makes sure you have enough cash on hand to support your expansion plans by monitoring and controlling your cash flow. Make backup plans and keep money set aside for unforeseen costs.
Investment appraisal is the process of evaluating potential investments to determine their financial viability and strategic suitability. It involves forecasting future cash inflows, assessing risk and uncertainty, and comparing expected returns with the cost of capital. The main aim is to support informed decision-making and select projects that increase firm value. Organizations use several appraisal techniques to achieve this. Net present value or NPV calculates the present value of future cash flows, helping identify projects that add value. Internal rate of return or IRR measures the expected rate of return and compares it to the required return. Other methods include the payback period, which focuses on how quickly an investment is recovered, and the profitability index, which measures investment efficiency by comparing benefits to costs.
Budgeting and financial planning. The problem is SME face difficulties in managing cash flow, utilizing resources effectively, and setting realistic financial goals. First is lack of strong financial planning. The solution is you can create a financial plan. For example, outline the expected income and expenses for the 6 months. Next is absence of proper budget control. Use budget controls. For instance, set a monthly spending limit for marketing and avoid overspending. Lastly is failure to review financial performance regularly. The solution is review finances regularly. For example, track monthly profits and expenses to see if you're meeting targets and adjust as needed. Cash flow management. What is the problem? First is poor cash flow management in SME makes it difficult for them to meet short-term obligations and leads to missing opportunities. How can this problem happen and what is the solution? First is lack system to track and forecast cash flow regularly. The solution is you can establish regular cash flow forecasts. Next is monitoring practices by utilizing accounting software specific for SMEs. And maintain cash reserve to handle unexpected expenses. Next is delays in customer payments and inefficient management of payables. The solution is improve receivable and payables management by establishing clear credit policies, follow up on overdue payments, and negotiating better payment terms with suppliers. Last is often allocate excessive funds to purchase fixed assets, leads to insufficient cash for operations. The solution is you can adopt a balanced approach by evaluating the return of investment, which is ROI of fixed purchase asset, and consider alternatives like leasing or renting equipment to preserve cash flow for operational needs. SMEs also face significant challenges in securing their business operations and growth initiatives. First, crowdfunding, raising funds from large number of people, which is through online platform by presenting your business ideas and offering incentives, which is low entry barriers for engagement and flexible models. Next is government grants, financial aids from government to SMEs to support growth, development without requiring repayment. And also it for aim fostering entrepreneurship, innovation or job creation, non-repayable tied to specific initiatives and eligibility criteria. Last but not least is venture capital. It is private equity financing where investors provide funding to startup or small business with high growth potential in exchange for equity. Equity exchange focus on high growth and also active in involvement. Risk management. SMEs has to implement risk management to mitigate financial risk management. First, diversifying clientele and revenue streams. Appeal to a wider range of customers and create more varieties of products. Reduce dependence on a single source of income. Next, financial controls. Management of financial resources to ensure they are efficiently and effectively. Present errors, detect fraud, facilitate activities and make informed decisions. Insurance. Insurance can protect the business from unexpected events that cause significant losses. Basic insurance coverage, which is business property, liability, and also business interruption.
Now, I will explain the calculation of the initial outlay. Initial outlay represents the total cash required at the beginning of the project. First, we start with the purchase price of the new machine, which is Rm820,000. Then we add with related costs includes the freight cost of Rm50,000 and installation cost of Rm85,000. This gives us the total purchase price of Rm955,000. Next, we add it with the training cost of Rm80,000. The market survey cost is excluded because it is a sunk cost. We also add working capital, which consists of inventory of Rm55,000. After that, we deduct cash inflows, where it consists of the sales proceeds from the old machine that the company will receive amounting to Rm58,000 and the tax loss on disposals of Rm10,080, which is derived from the calculation of NBV and loss on disposal. The net book value of the old machine is calculated as 300,000 of its cost minus with the accumulated depreciations of Rm300,000 divided by its useful life of 12 years times with 8 years, which equals to Rm100,000. This results in a loss on disposals of Rm58,000 of its cost minus with NBV of Rm100,000, which equals to negative 42,000 times with 24%, that equals to Rm10,080. After considering all cash outflows and inflows, the initial outlay for this project is Rm959,920. Next, I will explain the annual differential cash flow for this project. Annual differential cash flow refers to the difference in cash flows between accepting and rejecting the project. For year 1 to year 3, the savings includes the increase in revenues for Rm270,000, decrease in electricity cost of Rm70,000, and there is also a decrease in salary of Rm22,000, giving a total saving of Rm362,000. For year 4, the increase in revenue is Rm330,000, the decrease in electricity cost remains Rm70,000, and the decrease in salary is Rm35,000, giving a total saving of Rm435,000. Now, we deduct the cost, which includes the increase in manufacturing cost of Rm15,000, and there is also an increase in depreciation of Rm 154,000 that concludes to a total cost of Rm 169,000 for year 1 to year 3. For year 4, there is an increase in manufacturing cost of Rm 25,000 and an increase in depreciation is again Rm 154,000 that concludes to a total cost of Rm 179,000. After considering all savings and costs, the net income before tax for year 1 to year 3 is Rm 193,000 and the tax at 24% is Rm 46,320, resulting in a net income after tax of Rm 146,680. Since depreciation is a non-cash expense, we add back the increase in depreciation of Rm 154,000. Therefore, the after-tax incremental cash flow for year 1 to year 3 is Rm 300,680. For year 4, the net income before tax is Rm 256,000 and the tax at 24% is Rm 61,440, resulting in a net income after tax of Rm 194,560. After adding back depreciation of Rm 154,000, the after-tax incremental cash flow for year 4 is Rm 348,560.
Terminal cash flow is the cash flow received at the end of the project. In this case, the service value of the new asset is 60,000 ringgit. In addition, working capital in the form of inventory amounting to 55,000 ringgit is recovered. Therefore, the total terminal cash flow is 115,000 ringgit.
Now let's move on to question 4, which proceeds the calculation of net present value based on the provided data. First, we need to prepare a table and calculate the present value for each year. In year 0, the cash flow need to multiply it with present value interest factor (PVIF) for year 0, which is 1, giving a present value of Rm 959,200. For year 1 until 3, the cash flow is 300,680. To calculate the present value of this cash flow, we multiply it with present value interest factor of annuity (PVIFA) for 3 years, which is 2.4x69, resulting a present value of Rm 747,761.9 cents. For year 4, the cash flow is 348,560 per year. We multiply the amount by the present value interest factor (PVIF) for this year, which is 0.6830, giving a present value of Rm 238,066.48 cents. In year 4, we also count for the cash flow, multiply it by PVIF for year 4, which is 0.6830, resulting a present value of Rm 68,300. Finally, to determine the total net present value, we sum all the present value and got the total NPV of Rm 94,207.57 cents.
Next, I will explain the profitability index. The formula for profitability index is present value of cash inflows divided by initial outlay and plus 1. In this project, the present value of cash inflows is 94,207 ringgit and 57 cents and the initial outlay is 959,920 ringgit. So when we divide 94,207 ringgit and 57 cents by 959,920 ringgit and plus 1, we get a profitability index of 1.0981. Since the profitability index is greater than 1, this indicates that the project should be accepted.
For this question, we need to calculate payback period. To calculate payback period, the formula is equals to initial outlay divided by differential cash flow, which 959,920 divided by 300,618 plus 348,516, and the final answer is 1.48 years.
Next, I will explain the internal rate of return or IRR for this investment proposal. IRR is the discount rate at which the net present value or NPV of a project becomes zero. It is used to evaluate whether a project is acceptable by comparing it with the company's required rate of return. Based on the table shown, the initial investment at year 0 is 959,920 920, which is a cash outflow. In the following years, the project generates positive cash inflows of 300 and 680 in year 1 until 3, 348,560 in year 4, and 100,000 ringgit in year 5. To calculate the IRR, two discount rates are used, which is 10% and 15%. At a discount rate of 10%, the NPV is positive, which is amounting to 94,207.57. However, at a discount rate of 15%, the NPV becomes negative at 16,920.81. Since the NPV changes from positive to negative between 10% and 15%, the IRR lies between these two rates. Using interpolation, the IRR is calculated as follows: IRR equals 10% plus 94,207.57 divided by 904,207.57 plus 16,920.81 multiplied by 15% minus 10%. After the calculation, the IRR is approximately 14.24%. Since the IRR is 14.24% is higher than the company's required rate of return of 10%, this project is financially acceptable. Therefore, based on the IRR analysis, the company should proceed with replacing the existing machine. Advise the company whether it should replace the existing machine or not. The company should accept to replace the new machine because NPV is positive and the payback period is 1.48 years, which is lower than the expected payback period of 3 years. The IRR of 14.24% is higher than the required rate of return 10%.